A home equity reverse mortgage, or a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are age 62 years or older, and it has certain unique features that make it a valuable tool in retirement planning and aging in place. The HECM has some beneficial attributes. One is that in calculating the loan-to-value ratio, or how much of the collateral value they will lend, the Department of Housing and Urban Development attributes a certain annual property appreciation in its models. This video will take a brief look at how the HECM program gives you minimum home appreciation and line of credit growth. Let's look first at a 62-year-old with a $400,000 valued home, qualifying at the minimum FHA rate of 5.06% and the mortgage insurance premium rate of 1.25%. Effectively an annual compounded rate of 5.33%. As the example shows, the advance rate against the $400,000 assumed the property increased in value 2.25% over the life of that borrower. Let's take a look at how that happens. In this example, we calculate a line of credit of $209,600 on the $400,000 valuation. We allocate $190,400 for future interest and mortgage insurance because we assume you will not make a monthly repayment, but will pay off the loan when you sell your home. Whether you took all the money immediately or never took it, the balance on the HECM or its availability would grow by $414,400 to a total of $624,000 after 21 years of compounding. This means that the FHA expects your home to be worth this amount in the estimated year of your death, or put it another way, the increase from the original $400,000 appraisal valuation to $624,400 after 21 years assumed a 2.25% annual property appreciation rate. Note that the actual growth in the line of credit, or the actual balance on the loan outstanding, came from the release or use of the interest reserve, which is either not required or used up at the end of your estimated remaining life. But critically, it also included the increase in your home value over this time. So now let's look at a 75-year-old in the same set of circumstances and the same set of assumptions. In this example, we calculate a line of credit of $248,700 on the $400,000 valuation, primarily because we need less interest reserve. We only allocate $151,300 for future interest and mortgage insurance because it is a shorter life for this borrower. Whether you took all the money immediately or you never took it, the balance on the HECM or its availability would grow by $215,300 to a total of $464,000 after 12 years. The increase from the original $400,000 to $464,000 assumed a 1.25% annual property appreciation rate. This is lower than the previous 2.25% for the person age 62 due to less time for the growth rate to compound over their remaining life. As noted previously, the actual growth in the line of credit, or the actual balance on the loan, came from the release or use of the interest reserve and the increase in your home value as well over this time. In comparing home appreciation and credit line growth at age 62 or at age 75, the younger you take the HECM, and therefore the longer your estimated remaining life, the higher the assumed property appreciation and growth in the available line of credit. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers.
Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.